was already accepted that the Bank of England decision on rates is a secondary risk event compared to next week's spring budget, where the Chancellor has to convince stakeholders that her plan to hit benefits to balance the books is a good one. In South Africa, a similar challenge to push higher VAT in stages to expand fiscal space is also proving a tough act to sell and of far more interest than the Reserve Bank moves. Still, central bankers, and rightly so, changed the topic by focusing on uncertainties in the external front driven by a new sheriff in the White House. No surprises that both the Bank of England Monetary Policy Committee and South Africa Reserve Bank, just like the US FOMC, have all adopted a wait-and-see stance to get better clarity on implications of global trade and fiscal policy shifts before deciding to move on benchmark rates. Hello, welcome to Global Business Insights, where we analyze the main business stories. Today we look in more detail at two central bank decisions made yesterday in England and in South Africa. In the UK, the Bank of England's decision yesterday to hold rates was not unanimous, with Monetary Policy Committee member Swati Dhingra wanting a 25 basis points rate cut. The Bank of England reiterated that a gradual and careful approach to policy restraint remains appropriate, adding that domestic wage pressures remain elevated, though they are moderating. Labor costs have driven higher non-energy goods prices, and we've also seen weak economic growth. Earlier in the day, we had the Office for National Statistics reporting the ILO unemployment rate at 4.4%, as was expected. Average earnings, excluding bonuses, a major driver of high inflation in the services sector, rose in line with estimates and the former release of 5.9%. As business owners freeze hiring amid dissatisfaction over the UK government's decision to increase employers' contributions to social security schemes, we can expect wage growth momentum softening and employment growth also slowing in the near term. The big question is what will be in the spring statement next week, Wednesday. Rachel Reeves previously ruled out further tax rises, but she still faces difficult choices in a sagging economy and tougher external context full of uncertainties and risks. Already revealed are plans for major changes to the benefit system aimed at generating savings of £5 billion a year. Other government department budget cuts will be announced, and much of international aid funding will be reallocated to defense after a decision to increase defense spending to 2.5% of national income by 2027. But let's move on to South Africa, where analysts are watching how the finance minister will juggle a huge resistance on plans to raise VAT as critics call for more cuts on waste. Lesetia Nyanyago, the South Africa Reserve Bank governor, also warned in his speech yesterday that South Africa is vulnerable to the US suspending any trade concessions to South Africa as provided in the AGOA Act, that's Africa Growth Opportunity Act or AGOA Act, which is not likely to get any new traction. But let's hear more from the governor as he explains the reason for the hold decision, which seems to align with the wait-and-see mode taken by other economies trying to digest all the uncertainty.
Inflation in advanced economies remains elevated, with both headline and core inflation above 2% in the United States, the Euro area, the United Kingdom, and even Japan. Turning to South Africa, growth picked up in the fourth quarter of last year. As expected, the uptick was led by the household sector, boosted by lower inflation and withdrawals from the two-pot pension system. That said, the overall growth picture was disappointing, with other sectors showing weakness. Growth for 2025 was 0.6%, marginally below our expectations and slightly worse than in 2023. We have now revised down our 2025 growth forecast slightly to 1.7% while leaving the outer years unchanged. We attribute lower growth partly to subdued demand and partly to lingering supply fragilities. We assess that the risks to growth are to the downside. Moving to prices, while inflation is still in the bottom half of our target range, it has edged higher over the past few months. We continue to see low inflation for goods, which is likely to be temporary. Services inflation is somewhat higher, but still below the 4.5% target midpoint. Inflation expectations are close to the midpoint. For now, inflation appears contained. In terms of the outlook, the current forecast had more moving parts than usual, including a reweighting of the Consumer Price Index by Statistics South Africa and the proposed value-added tax increases announced in the budget. We have also adjusted assumptions such as the oil price to reflect shifts in global markets. The overall result of these changes is a marginally lower inflation outlook, with headline now projected at 3.6% this year and 4.5% next year. This is mainly due to the better fuel price projections. It also reflects a more benign path for administered prices, given the lower electricity tariffs announced by NERSA in February. These factors offset pressure from the proposed VAT increases, which we think will add about 0.2 percentage points to headline inflation. We see risks to this forecast on both the upside and the downside, with the balance of risks in the medium term skewed to the upside. Against this backdrop, the MPC decided to keep the policy rate unchanged at 7.5%. 4 members preferred this action, while 2 favored a cut of 25 basis points. For several quarters, we have enjoyed rising confidence in South Africa, with a smaller country risk premium and lower bond yields. However, the global economy is not on a stable footing, and there are also domestic uncertainties which put these favorable trends at risk. This calls for a cautious approach to policy. As before, the forecast sees rates stabilizing at a neutral level of about 7.25%. This rate path from the quarterly projection model remains a broad policy guide. The MPC would like to emphasize that its decisions will be made on a meeting-by-meeting basis and will continue to be outlook-dependent, responsive to data developments, and sensitive to the balance of risks to the forecast. Given the uncertain global situation, the MPC spent some time during this meeting exploring different external scenarios. For one, we considered a slowdown in the US with a weaker dollar and higher commodity prices, especially for gold. This implied some modest benefits for the South African economy, given better terms of trade and a stronger rand. Both inflation and the policy rate were therefore a little lower relative to the baseline forecast. We also explored scenarios we built around changes in South Africa's access to markets in the US. If South Africa were to lose AGOA benefits, we see some weakening of exports and slightly lower growth. If that were compounded with tariffs on South African exports, the effects would be larger. The most severe scenario we considered added a sentiment shock with a weaker rand, higher domestic inflation, and therefore a tighter policy stance. In this case, growth would be lower by 0.7 percentage points, with the exchange rate depreciation offsetting some of the tariff effects on exports. In a difficult global environment, it is vital to sustain domestic reforms that boost growth while preserving macroeconomic stability. The MPC's main contribution is to deliver low and stable inflation with well-anchored inflation expectations. The committee remains vigilant and ready to adjust policy as needed. Additional measures that would improve economic conditions include reaching a prudent public debt level, further repairing and strengthening network industries, lowering administered price inflation, and keeping real wage growth in line with productivity gains.
After a short US Fed rally, it was more volatility driven by the uncertainty still weighing on equities as a mixture of buying dips and caution saw the S&P 500 lower yesterday. Dow was down. The Nasdaq Composite fell 0.3% as Apple shares sank. Meta and Nvidia, however, saw their stocks each rising almost 1%. And Donald Trump has signed an executive order directing the Education Secretary to begin dismantling America's Department of Education. The order stops short of abolishing it, which would require congressional approval. Trump says a decentralization of the spending to the states, which cuts out bureaucracy, works better for education in the U.S. Executives in the European Union are postponing until mid-April a set of retaliatory tariffs on US products, including on bourbon whiskies. The Commission said it wanted more time to consult governments and to allow all countermeasures. The first set, which was due to come into force on 1st of April and the second scheduled for mid-April, to be assessed altogether. Accenture has warned yesterday that Elon Musk's efforts to slash government spending have started to affect its revenues, also highlighting threats from global economic uncertainty. New work for the US government, which accounted for about 8% of its $16.7 billion in global revenue in the last quarter, has slowed sharply after the new administration took office in January. Some self-disclosure: I retired as a director in Accenture, but Accenture is not a sponsor or has any influence on these broadcasts. Former Credit Suisse Chief Executive Tidjane Thiam has been relieved of his French citizenship, potentially clearing the way for his bid for the presidency of the world-leading cocoa producer, Ivory Coast. The elected leader of the opposition PDCI party in 2023, Thiam is expected to be a leading contender in the October election. The Heathrow Airport in London will be shut all day today after a fire caused significant power outage, throwing travel plans of hundreds of thousands of people into chaos. Asia Pacific markets closed mixed as Wall Street losses and uncertainty around the US economy continue to weigh on sentiment. Japan's core inflation hit 3.0% in February, signaling broadening pressure that reinforces market expectations of further interest rate hikes. Oil prices rose today, set for their second consecutive weekly gains after fresh US sanctions on Iran and a new OPEC Plus plan to cut output raised bets on tightening supply. Well, that's all on this episode of Global Business Insights. Enjoy your weekend. Thanks for watching. This is Bode Oshosami. Bye-bye.